Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment.
Well, greetings and welcome to the Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, in this episode, I want to continue the discussion about the market environment and whether we should be anticipating a bit of a pullback or a slowdown. Things have been really good. Markets have been resilient. Economy has been resilient. And, we're starting to see a few cracks. So it's really about opening up that discussion to sort of say, hey, what are we looking for and what might happen? And are there any ways to kind of get ready for a potential pullback? So let's jump in. And, as ever, we'll start with sort of the geopolitical environment. We know that there's ever-present U.S.-China competition, other geopolitical tensions out there. We focus, for example, we'll get into this in a minute, the idea of the fiscal trajectory in the U.S. creating some instability potentially, and worries about things like cyber attacks. But as ever, the military hotspots are in focus. We've got Russia, Ukraine, and then while a fragile sort of ceasefire between Israel and Hamas, that's sort of been stirred up again. So again, there's tension around the current environment and especially the military hotspots. That's against a backdrop where we've seen major changes in D.C. with the second Trump administration, all kind of old news now, but things like, tax policy changes, things like tariffs and trade, aggressive policies, et cetera. And so, we're all sort of navigating that. As we mentioned last time, it was a significant event that the spending bill passed. Now we're in a shutdown right now, and we're waiting sort of a negotiated resolution on that. But the punchline on the spending bill is, even though we're seeing the potential for a little bit of a slowdown in the second half of 2025, there's a view that the spending bill will ultimately be stimulative next year with after tax, just a little bit more money in people's hands. And that kind of brings us to the economy. The economy continues to grow and stay positive in terms of its growth. And, with the consumer making up a little over 2/3 of economic growth, keeping an eye on the consumer is super important. So we've seen pretty robust retail sales. We've seen softening confidence and sentiment. We know that there's a little bit of a worry when it comes to debt. And we know some data is showing slight cracks in the labor market. So while some of the data we track isn't being released because of the shutdown government, the bottom line is we're seeing, generally speaking, some resilient data. But as it relates to certain parts of the job market, just some cracks. Non-farm payroll is one that we've talked about, and we're kind of awaiting more data from the government, of course, but again, it's shut down. But when we look beyond that to other things that would be influencing the consumer, we can look, for example, at the contribution of consumption to GDP growth. And when we look back, over let's say the decade before the pandemic and the calendar years of 23 and 24, you can think of a number, somewhere between roughly 1.5% and 2% being sort of the annualized growth contribution of consumption. And that's down to, in very round numbers, about 1% annualized for the first half of 2025. So we've seen a little bit of a slowdown. We're seeing a little bit of a pop in delinquency rates on credit cards. We're seeing, again, the idea of the labor market cooling. Some private sources like ADP is showing some softening in the labor market. Various entities will kind of point out things that are going on. So the Fed has what's called the Beige Book, and that's showing some strain among lower and middle income consumers. But then again, when we hear on earnings reports, some CEOs are generally speaking indicating the consumer's holding up reasonably well. And so there's, more to keep an eye on. But the punchline here is there's a view that for the full year of 2025, we're going to be in the, just under 2% range. The consensus is a growth rate of 1.8%, but with the potential for a little bit of a slowdown towards the end of the year here. So that's something that is really in focus for everyone. We know that the Fed, in some ways, has been celebrating what has been slightly softer inflation. Inflation has come down not to, but close to their 2% target when we look back, let's say, over the last 6 months. And so the Fed did cut rates, and the market is anticipating a number of more cuts from the Fed through the balance of this year and through next year. So there's a little bit of optimism around the Fed. And of course, what we have to be mindful of is they may slow that down if they're worried about inflation, and perhaps more worried about that than the job market. Now, I mentioned the fiscal transition. This is the idea that we've built up quite a lot of debt, especially in the federal government. When you couple that with higher interest rates that are here and expected to be here for a while, that means the cost of debt is starting to crowd out the rest of our federal budget. And so there's a number of folks that are kind of talking about trying to see how we can get that back on track. And, you know, one of the frameworks that we've spent a lot of time reviewing is the idea, it's pretty straightforward. You think about both the deficit and the debt as a percent of GDP. So it's almost like as you grow the economy, GDP goes up. That gives you more capacity to handle deficits and debt. But to give you some numbers, we're currently, in terms of the deficit, at over 6% of GDP. And the goal, I think one goal that's been put out there is to get down to 3%, let's say, over the next 10 years. And then our current level of debt is at about 122% of GDP. And a good level is somewhere in 60 to 80% range. And so, you know, what these numbers are kind of starting to show is that we've got to develop a path to kind of reduce our deficit, really bring it down a good amount, think in the neighborhood of $7.5 to $9 trillion over the next 10 years. And then ultimately, you know, we're talking some form of austerity, right? So needing to cut spending. We should probably be realistic to say that entitlement programs may need to be reformed, and then we're looking for efficiency gains, but then also the idea of potentially higher taxes. And, you know, on one hand, you can increase tax rates. Another way to do it, of course, is to grow the economy and, you know, create more revenue, therefore more earnings, therefore more taxes. And so those are the kinds of things that we hope will come into even greater focus to get ourselves on a track towards these kinds of numbers that would really represent an improvement. Now, when we look at the market environment, we remain in an interesting state where interest rates have remained elevated, 10-year treasuries sitting in round numbers of around 4%. And again, that reflects, therefore, the higher cost of debt. When we look at yields on various categories of fixed income, the punchline is that they remain pretty appealing in terms of the potential for investing on a forward-looking basis. And so, you know, that idea of sort of the bond market holding up and being a good place to invest has been good. But, you know, there's been a lot of optimism in the stock market. Now, on one hand, you know, it's interesting to watch that. We try to think, okay, what are the tailwinds? What are the things that people are focused on? So we'll talk in a second about AI. But I would say more generally, you know, we get pretty interested in what I think of as major changes going on in the world that could end up being a positive for companies and therefore for stocks. So we have a long-term theme framework, the idea that competition like that between the U.S. and China is productive. It makes us better. We're seeing new forms of consumption and behavior in consuming. We're seeing the need to secure strategic resources, creating almost like infrastructure opportunities and shifting demographics. A good example is a focus on longevity and the kind of healthcare innovation that is being pursued because of that. And finally, the fourth industrial revolution is all about technology and innovation and the idea of breaking boundaries between the physical, digital, and biological worlds. And while AI is sort of spread out through all those different themes, it's certainly very present when it comes to the fourth industrial revolution. So we've done a good amount of work on AI, of course, and published a lot. I'd say the things that we've gotten into include the idea that ultimately the labor force will be better for it, but there will be a reallocation of labor. The idea that AI is really a new tailwind with a focus on productivity and profits, and the idea of just being more efficient. And then we dug into a few industries, healthcare, where we're seeing significant use of AI, as well as I think digital security, cybersecurity, as well as the finance industry and financial industry. And so, a lot of interesting things going on with AI. And ultimately, when it comes to the way companies are performing, certainly supported by some of the AI efforts and spending, we're seeing profit margins remain pretty healthy. We're seeing earnings continue to grow at a very healthy pace. And all of those things are a tailwind to the market. So the market continues to climb higher. We set a target for the full year. As we started the year, we hit that target at mid-year. We revised our target higher, and we've gone past that. So, we're kind of in this territory where the market's recovered pretty much fully and beyond since the lows of April when the tariff and trade scares hit. But we are at a place, therefore, as we've seen for quite a while, that where valuations on a traditional price earnings metric basis are very elevated, meaning we're richly valued. And lately, that number of premium to long-term average is about 26%. So the market's about 26% overvalued on a PE ratio basis compared to that average PE over the last 10 years. That's cap weighted. So those big tech-oriented companies that have been doing really well and growing a lot have sort of driven those valuations higher. And when we look on an equal weighted basis, look at the broader part of the market on a more equal weighted basis, there's a premium, but it's only 3.5%. So things are a little bit more fairly valued, quote unquote, when we look at the average company rather than those big tech-oriented companies. Now, what does all this mean? Well, with things elevated, we just want to keep an eye out, number one, for the potential for a pullback, kind of be ready for it, right? It's been an incredibly resilient economy and a very strong equity market. When things get richly valued like this, it's almost like any little cracks. It could be labor market, could be stirring further activity in the military hotspots. It could be some disappointments with earnings, or what's in focus for sure are the credit markets. Are we seeing cracks in the credit market where people who have borrowed money aren't able to pay it back? All of those things, any of those things could cause the market to pull back a little bit. And we've talked a bit about not waiting for the pullback in the sense of thinking through the kinds of things that you might be able to do if the market is going to pull back, or maybe after it does. So, for example, if you have money to invest in stocks, take a dollar cost averaging approach, which means ease into it. And if the market goes down, then in a weird way, that's next step that you would implement would be at a better price. And so there's that technology and approach, I should say, or technique is probably a better word. Anyway, then there's the idea of rebalancing. If you have a certain blend of stocks and bonds, for example, and stocks perform better, then the weighting in stocks relative to bonds goes up a little bit, you can rebalance and get back to your preferred weighting. We have some clients we know that are wanting to de-risk, meaning maybe they're getting closer to or entering retirement and they want to lower the volatility of their portfolio, maybe lower by doing so through the idea of reducing equity exposure. It's actually a good time to do that when equities are up. You're almost like taking the earnings off the table and de-risking a little bit. And then finally, when it comes to sort of worrying about bigger troubles, there are things that we would call, quote unquote, black swan ideas. So precious metals would fall into that for sure, hard assets, commodities, things where it's sort of like investments that are not correlated to traditional stocks and bonds, a lot at least. And so we've been spending a lot of time talking to folks about different ideas to kind of protect the portfolio in periods of extreme trouble. But then also I'd say when we see a pullback, if people are wanting to build a position or add to positions in stocks that have gone up a lot, usually on the pullback, some of those stocks may lead the way down, meaning creating a more attractive entry point for those that might be looking and waiting for that kind of opportunity. So again, there's just a lot to consider as we anticipate the possibility of a pullback. Some things you can do beforehand, other things you kind of wait and be ready to strike when a correction occurs. And we would just say this is a good environment to be talking to your Stifel financial advisor and talking about those kinds of potential opportunities. So, hey, listen, that's what we wanted to cover in this episode this month. We really appreciate you taking the time to listen, and we'll catch you in November. Thanks so much.
Thanks for listening to Stifel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.